In the first 6 months, we've delivered double-digit revenue and earning growth with strong cash conversion. We've announced an interim dividend of 19.4p, up year-on-year by 14.1%. The group generated revenues of 1.2 billion, a double-digit growth of 13.6% at actual currency and 10.6% at constant currency. The organic growth rate was 3.1% at actual rate and 0.5% at constant currency. Robust organic growth in products and solid organic growth in trade were partially offset by challenging conditions in our resource sector. The 5 acquisitions we made since January 15 are performing well and contributed 113 million of revenue. Disciplined cost and margin management are important priorities for us. In H1, we've benefited from the cost restructuring activities over the last 2 years and from our disciplined performance management approach to pricing, mix and cost. In the last 6 months, the group operating profit of £186 million was up 13.1% at actual currency and 11.3% at constant currency. Overall margin improved by 10 basis points. Moving forward, we'll remain very focused on cost and margin management. We have delivered an adjusted EPS of 74.5p, up 14.1% at actual currency and 11.4% at constant currency. Cash management is also very important for us. In the first 6 months of the year, we've delivered strong cash conversion. We've continued to invest in growth with a combined investment in CapEx and M&A of £50 million. I would like now to give you an update on each of our divisions. Our product-related businesses delivered an excellent revenue performance with double-digit growth and a robust organic revenue growth performance of 5.6%. In addition, we have benefited from the contribution of the acquisitions made recently. Looking more closely, our softline and hardline businesses delivered a robust organic growth performance on a global basis. Our transportation technology businesses delivered double-digit organic growth across the main markets in the US, the UK, Germany and China. Our business assurance business generated double-digit organic growth in our 3 regions of North America, Europe and Asia, benefiting from the increased focus of our clients on risk management. We have delivered a solid organic growth in both our electrical and wireless businesses and chemical and pharma businesses. And the increased focus on food safety delivered good organic growth in our food business. Our building and construction businesses delivered also a robust organic growth performance, driven by the growing demand for greener and higher quality buildings. PSI in the US benefited from good revenue momentum and the integration plans are on track. Our trade-related businesses delivered solid organic growth of 1.1% with stable margins. Our cargo AA business reported a solid organic growth performance and our agriculture services businesses delivered also robust organic growth. Demand for our GTS services continued to be weak. Our resource-related businesses saw an organic revenue decline with slight margin erosion. As expected, the revenue from CapEx inspection services was lower than last year. Demand for OpEx maintenance services and testing in the mineral businesses remained stable overall. Before discussing the outlook for the group, a few words on the implications of Brexit. The UK represents 8% of our global revenues, and we expect a forex translation impact for 92% of our revenues. We do not believe that Brexit will impact the future growth opportunities for us. The group is on track to deliver its 2016 full-year targets. Specifically, we continue to expect to deliver an overall robust constant currency performance with solid organic growth. We expect our product-related businesses to benefit from robust organic growth. Our trade-related businesses should continue to deliver solid organic growth. We'll continue to face challenging trading conditions in oil and gas CapEx inspection services. We'll continue to benefit from the acquisitions that we made last year. We'll also remain very focused and disciplined on cost and margin management. We continue to expect our group operating margin to be broadly stable year on year. And of course, we'll continue to invest in growth, and we expect our full-year CapEx investments to be circa 110 to 120 million pounds. From a net debt standpoint, we expect to close the year with a net debt of circa £770 million to £820 million. This full-year net debt guidance is before any additional M&A activities and no further material movement in Forex. In the medium to long term, we believe that the industry will benefit from global GDP plus organic growth rate in real terms. The growth prospects in the product space are driven by the need for corporations to build their brands, constantly innovate, raise their quality standards, meet regulatory standards, and increase their focus on risk management. Our product-related businesses will continue to grow ahead of global GDP growth. The trade-related businesses will continue to benefit from the expected growth in global trade and from the development of regional trade in Asia, the Indian Ocean, the Med, and the Americas. We expect our trade-related businesses to continue to grow at a rate broadly similar to GDP through the cycle. The resources business are more cyclical, and from time to time, we have to cycle through periods of low resource prices. Investment in exploration and production will grow in the medium to long term to meet the demand of the growing population around the world. In summary, we've delivered double-digit revenue and earning growth, driven by an excellent performance in our product-related businesses. In line with our 5x5 strategy, the center of gravity of our portfolio is moving towards the attractive growth and margin opportunities in the industry. Cash conversion remains strong, and we continue to be disciplined with our capital allocation, targeting businesses with good growth and margin prospects. We are very well positioned to benefit from the attractive growth prospects ahead, leveraging our high margin and strongly cash generative business model.